Hey guys, welcome back to the channel. In this video, we're going to go over a article that's been making its way in the finance space, specifically talking about how the S&P 500 is going to underperform over these next 10 years. So we'll go through that article, and I just want to share some of my own thoughts about it because I do own a sizable position in an S&P 500 index fund. And then at the end, we'll go over a quick portfolio update. So without further ado, guys, let's get into it. And I will link this article down below in the description for you guys so you could read it at full length. All right, so the article starts, wave goodbye to the stock market's historic run, Goldman Sachs says. And this article came out October 21st. And basically, we're going to talk about the key takeaways because I don't want to read throughout this, this whole article and bore you guys to death. But here are the key takeaways. Analysts at Goldman Sachs on Monday forecast that the S&P 500's average annual return over the last decade of 13% will shrink to just 3% in the next 10 years. The index's extreme concentration, they say, is one key reason the S&P 500 will deliver such paltry returns. And then Goldman Sachs estimates that the equal-weighted S&P 500 could outperform the regular S&P 500 index by as much as 8 percentage points a year through 2034. So, first things first, like I said, I do own a sizable position in an S&P 500. And, when I read these headlines, the first thing that comes to my mind is, delete it. Just ignore it. But, at the same time, it is good to just read other, thoughts, other opinions and other forecasts and everything else, just as kind of a data point, just to keep it in the back of your mind. This isn't really going to change much about my investment strategy, but again, maybe it might for you, so let's kind of just work through this. So they're basically stating that the index has an extreme concentration, right? And it is true. If you look at the concentration of of the top 7 companies, it's going to be Apple, Nvidia, Microsoft, Google, Amazon, Meta, Facebook, and Tesla, right? And these companies, these large tech companies, basically drive the share price of the S&P 500. I know that's a pretty bold statement. There is an argument that I've seen out there saying that if you own the S&P 500, you might as well just own a tech stock at that point, or, a tech fund, tech ETF at that point, because, as these 7 companies go up or down in value, so does the S&P 500. It's almost like, the Magnificent Seven plus the other 493 companies. They basically downplay the other 493 companies. So there is an extreme, kind of concentration with these companies. And basically the article is stating that, over the last, right here, they more than doubled their earnings on a year-over-year basis for the first quarter of 2024. The 10 largest stocks in the S&P 500 currently account for about 36% of the index, far higher than any other time in the last 4 years. So they're also stating that these companies have had double-digit returns, over pretty much the last decade, and that they don't think that this is sustainable in the future, that over the next 10 years, there will be declines in these companies, which will drive the S&P 500 down. And they go on to say that investing into an equal weighted S&P 500, index or an ETF would be better, and it would return or have a better return profile than investing in the S&P 500. All right. So it says right here, history shows, however, that it's extremely difficult to sustain earnings growth at that clip. Just 11% of S&P 500 companies since 1980 have maintained double-digit growth for 10 plus years, according to a Goldman analysis. A microscopic share of 0.1% has sustained 50% of margins for a decade. Okay, so, again, they're predicting that these companies, these big Magnificent Seven, these huge tech companies, are not going to be able to sustain their earnings growth. And, real quick, for those of you who don't even know what an S&P 500 index is, it's basically a basket of stocks of the 500 largest companies in the United States, right? So when you buy an S&P 500 index fund or ETF, you're basically buying a basket of 500 companies. All right, so with that out of the way, let's talk about what this equal weighted ETF actually is. So I already have it all picked out for you guys. Let me move my head over here. So this is the Invesco S&P 500 equal weighted ETF. You can go to Seeking Alpha, sign up for a free account. You don't have to pay for a premium service, or you can look for this on Yahoo Finance. But let's just take a quick look at this. So we see that it has an expense ratio of 0.20%, which is a little higher than SPY or even VOO, which are your standard S&P 500 ETFs. And it does pay a quarterly dividend, a yield of 1.48%. But what we really want to look at is the holdings here. And if we look at the holdings, we do see that the top 10 holdings are far different than what is traditionally in an S&P 500 index. So, and you can see also the weightings for each of these, 0.24%, 24.24%, 0.25%, 0.26, 0.29, right? If we were to actually look at VOO, which is the Vanguard S&P 500 ETF, which is typically a benchmark used by most, we can see that it's far different, right? You have the Magnificent Seven at the top. Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, basically here. And you can see their weightings are far different. Now, these don't have the full seven. So this is 1, 2, 3, 4, 5, 6. So it's missing one. Oh, Apple. I'm sorry. I'm blind over here. So it does have the Magnificent Seven at the top. And you can see that their weightings are far different than an equal weighted, S&P 500 ETF. And if you wanted to really look into it a little further, RSP, because it might be something that you might be interested in, right? If you believe Goldman Sachs and you believe the analysis that these companies are going to underperform over the next decade, and you want to kind of open your portfolio to an ETF version, an equal weighted S&P 500 ETF version, then RSP might be a good candidate for that slot. So we're here. I was looking for something. All right, I don't see it here. Let's go to Google, and we're gonna check out Invesco RSP. Right, this is how you guys can look at the actual web page for the ETF. So we're gonna go to the product details here. Let me move my head. So we're gonna go to product details here, and we're gonna scroll down. What we want to know is the portfolio. So here, yada yada yada. So again, top holdings, but we want to see what the full holdings are. Fund holdings. Maybe this might be it. So I'm doing all this live for you guys, just so you guys can kind of see how you can go and do this if you've never done this type of stuff before. So here we can actually see all the holdings it has. And if we look at Amazon, we see it only comprises of 0.19%, right, of the fund. If we look at Netflix, same thing, 0.21. And if we look at Apple, 0.20. All right, so, now comes the question. They're saying that an equal weighted ETF is going to outperform the S&P 500 over the next decade. That's their forecast. That's their prediction. I'm sure they probably have, a bunch of intelligent people who came out with this, forecast. But I'm just a simple retail investor, and I want to take a look at something here. Let's see how they actually compete against each other, right? Let's look at the historical context of these, or the historical data of these ETFs. So we're going to use VOO. You can use SPY if you'd like, but I'm going to choose VOO. We're going to go with $10,000 as the initial capital. We're not going to add any additional capital. We'll reinvest a dividend. Sure, why not? So we're going to go with VOO as our kind of our benchmark. We're going to give that 100%. And then we're going to go with RSP as our next one. And again, we just want to see what the difference is in return profile, okay? Because they're saying that the equal weighted S&P 500 is going to return about 8% annualized, or 8 percentage points more annualized than the S&P 500. That's a pretty bold claim. So I'm just curious what this would look like. So we can scroll down. So we can see that, since 2010, they've pretty much been neck and neck. And it was only until about, 2018, then you start getting into, the pandemic happened here, low interest rates, and then high interest rates. So it looks like, and then now we're on an interest rate easing cycle. You can see that RSP is actually underperformed quite a bit. And again, this is over 10, 14 years. So I don't know. You'll have to kind of draw your own conclusions. I personally don't think the equal weighted S&P 500 is going to outperform the S&P 500 ETF. It's just, I know that's a bold claim. The only thing I could think of, or the reason is I wouldn't want to introduce an equal weighted ETF to my portfolio because I'm so heavy in an S&P 500 index anyways. And I'm not going to reallocate funds. I'm not going to add the ETF and then, sell shares to buy into this new ETF. So I wouldn't do that personally. Also, a couple other thoughts here. The S&P 500, it has a historical track record behind it. Again, since 1920, it's returned on average of about 10%. This equal weighted ETF, I don't know how recent it is, but again, I probably wouldn't bet my money on it, is all I'm saying. You could, if you wanted to do kind of a risk mitigation type of strategy, if you really believed, in the analysis from Goldman Sachs, you could, do like a 50-50 if you'd really prefer. But, for me personally, I'm probably going to just ignore it, stick with the S&P 500, continue dollar cost averaging, where I can, and then just go from there. All right. So with all that out of the way, let's hop into the portfolio and get a quick update on where we're at today. So today is actually, what is today? Today is Friday, the 25th of October. I probably won't be posting this video until about Monday, which I believe will be October 28th or 27th, one of those days. But anyways, I won't be posting until Monday. So I just want to give you guys a quick overview of the portfolio, quick update. So let's see. We have a ending cash value today at $221,000. $221,933,000. I have a market gain of $7,327. I have been getting dividends. That's why you see this cash up here. It's just kind of sitting. I'm probably not going to use that money to reinvest into the securities that it came from or the REITs that it came from because I just want to hold some cash right now. But in total dividends, $16,672. I have a money weighted return of 17.08%. So I don't really talk about the BDCs as much, or this company is more of a meme company. I mostly invest my money into equity REITs, as you guys know. And this is where I spend, a majority of my or where I invest most of my money. So, again, just looking at everything, that sucks because I know Alexandria Real Estate had recovered briefly for probably about a day or so. But again, I don't know what's going on. I recovered, the portfolio recovered, and then it just been kind of on a downward trend. And I think it has to do with we're in this funny period where there's a lot of indicators saying that we're headed for a recession, but then there's also a bunch of other indicators saying that the economy's strong, we're doing just fine. And there's still a lot of uncertainty out there, especially out in the world with, geopolitical unrest, wars, etc. And it's just driving our market insane. And then plus this is an election year. On top of, we still have elevated interest rates, so it's obviously affecting the REIT market. So I don't know. This thing has been bouncing up and down quite a bit. I'm hoping that it'll recover soon. Yeah. So as you guys can see, it recovered here in October, or was recovering here in October, and then it's kind of just going down. So I'm not too concerned about it. It doesn't really faze me as much. I mean, I'm invested for the long term, and it's during these times where you have to remember what you're investing in, why you're investing in it, and really understand your investment plan, your investment strategy. All right. So, that'll probably pretty much do it for this video. Shout out to JT for sending me the link on the Goldman Sachs article. Really appreciated that. And yeah, if you guys are interested in joining the community, I'll put a link down below in the description. But other than that, guys, that's all I got for you. I'll see you guys in the next video.